Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a company valuation expert in St. Louis, Missouri. During this episode, we will actually discuss tax considerations in private company transactions. So we have the privilege to discuss these issues with a tax accountant and business valuation expert in Franklin and Nashville, Tennessee, Brad Smith. The goodwill is basically what's left over a lot of times.
Right.
So it just comes, and so I think most people conceptually have an idea of what goodwill is or that it's a component of the company.
Mhm.
But what are some of the tax implications of goodwill in the sale of a company?
Sure. So, like you mentioned, if goodwill is organic, meaning it's been internally created, the business owners aren't seeing it on their balance sheet. It's not something that the accountants have posted, and that
There's no line item.
No line item. Unless they purchased a business, there's generally no goodwill on the balance sheet. Hopefully, the goodwill is the largest asset they have in their purchase price allocation. That means there's tremendous value that's being transferred to the seller. So the good news is that for the seller, goodwill is a capital asset. So it's for federal tax purposes. It is going to be granted long-term capital gain treatment under current rates, 15 and 20%. So that's about the best we can hope for. With respect to companies in various states, there can be some planning opportunities with goodwill. And one potential is bifurcating goodwill into a business component and a personal component. And so depending on the engagement and the location of the company, in Tennessee, for example, there is opportunity if we can isolate that personal goodwill. While we get the same federal tax outcome, we might save a tremendous amount of dollars in state tax. So I've done deals in Florida and in Tennessee. In Florida, that's kind of a neutral issue, but in Tennessee, it is an issue, and it is something that we have to actively pursue.
And part of this is understanding the difference between personal goodwill, which is kind of attributed to the owner,
Yes, ma'am.
and enterprise or company goodwill. And there's a lot of different terms for it. But in essence, it's goodwill that is associated to the company, its reputation, its client relationships, all of that type of stuff that
Sure.
we're trying to distinguish because there's tax advantages for it being personal goodwill as opposed to corporate goodwill.
Correct. And from a buyer perspective, goodwill is required to be treated a certain way on their books. So regardless of the business or personal classification that we end up assigning it for purposes of the transaction, the buyer's in the same position. So it's a good topic because you generally have little to no pushback from the buyer on that item.
And what we've seen even in deals, just so, because a lot of people, if they've been running their business for 30 plus years, they really may not have sold or bought a business before.
Right.
And so some of it comes at the very beginning that you're trying to determine the purchase price, and there could be an allocation. So they'll then give you an allocation. And that's the time to really start negotiating those pieces as opposed to after the sale. I think that's what you said earlier.
Absolutely. It's a LOI or pre-LOI event, not a post-closing event. The Internal Revenue Service requires that both buyer and seller complete a Form 8594 where they record and agree on what those final allocations are. And so it's real important that everyone get on the same page. And part of our due diligence, if we're representing a seller, is to really go through those assets and understand what levers we can pull and what sensitive areas might exist. So you can have a client that may have a lot of equipment, depreciable property, and with these accelerated depreciation options that we have and have had for quite a while, their basis in these assets could be very low, but the value of those assets could still be significant. And so the seller needs to understand that there is a recapture component of that creates ordinary income to them based upon that allocation. So that can become a very sensitive matter that we want to work through, for sure.